So good evening, everyone. My name is Frank Congelos. I am the managing partner at CNA Financial Group. I welcome all of you to our Wisdom Wednesday. This is a program that we put on every month, typically on a Wednesday night like we are this evening. And the whole objective is to really provide you with insights and perspectives on different areas of finance. So we've got a great program for you this evening. I have one of my friends, his name is John Resnick. He's with Efficient Advisors. And John and I had met, it's probably going back about 15 years ago, that when I first came into the business, I was finding out a lot about investments, and every time I would turn around, we had a new wholesaler walking in the door, showing us, different products and different programs that they have. And there was really no rhyme or reason to what was occurring in the investment world back then. And then all of a sudden we were turned on to a program that actually took us to what we refer to as the academic side of investing, of really understanding where do returns come from, what happens with markets. And what we found is that by adhering to more of the academic side of what's going on, people were getting outcomes that they were hoping for. They were able to rest a little bit easier at night when there was volatility, because they had perspective on what's actually occurring and how are investments really supposed to respond and how have they responded over time. So I always say is we never have a crystal ball. I can't tell you what's going to happen tomorrow. But if you really have a perspective on how money works, how investing works, and where returns come from, it'll give you more peace and it'll give you a better basis for making better decisions. So with that being said, I'd like to welcome our guest speaker tonight, John Resnick. John, it's a pleasure to see you, and it's a pleasure to be with you this evening. And so I'm going to turn it over to you at this point, and I'll just be here for comments and for a little input here and there.
That sounds great. Thank you, Frank. And thanks, everybody, for making the time to join us this evening. It's an honor to be here with you. So we'll just kind of walk through a few things that underpin or provide the foundation for why we do what we do in the world of investing. And to the extent you all have questions or whatever, I would imagine you'll manage that. We can deal with that along the way as we go. So just a little bit about Efficient Advisors. I don't expect you all to read this, but we've been around since 2009. Essentially, our mission is to be an extension of the office and practice of firms like Frank's. Like, we help advisors do what it is he does in your financial life. We manage a little over $2 billion, and we do that exclusively through independent advisors who help folks like you understand what you're doing and why with respect to your investment. So this evening, I just want to visit with you a little bit about what our approach is and why we do it the way we do it, and maybe get a better handle, give you a few handles on what makes the most sense to do in pursuit of returns in global markets over time, right? So if we think about the macro reason why you invest, or what investing is all about, I think you could boil it down essentially to these four things, right? So on the left-hand side, we have risk and cost. And of course, we would wish in a perfect world that this could be zero, right? You could have such a thing as zero risk and no cost. That would be fantastic, but that's not how the real world works, and we know that. And on the right-hand side, we have return and probability. And of course, we wish that you could have infinity return and 100% probability. I know I'm using an extreme example just to make a point, but we all know that that's not feasible either. So the reality is, what we have to do in our investment strategy, and really in our whole wealth management strategy, is manage these four things and how they interact with each other, and be careful about over-focusing on any one of these four squares. We can't focus on return to the exclusion of everything else. Like, that would be horribly risky, right? We can't solely focus on cost to the exclusion of everything else. We know it's going to cost something to engage in a process that is meaningful and evidence-based, right, in our investment strategy. So the goal here is, more than anything, just to keep the arrows going in the correct direction. right? On the left-hand side, as much as we can, let's minimize risk and cost, understanding it can't be zero. And as much as we can, go for the maximum amount of return for the given level of risk with the most probability we can. The other thing that also means is if we can identify anywhere in your investment process where you have these arrows going the wrong way, right? Undue risk or undue cost, we shouldn't do that. Or if you have things that are decreasing your return or lowering your probability, we shouldn't do that either. We should try and get that out of your process. So as we manage money for thousands of investors like you, our philosophy is really based on the evidence, math, science, statistics, and decades and decades and decades of evidence that says it makes the most sense to trust markets to create wealth for you over time. So we'll just kind of touch on these 4 things as we go through the conversation this evening. And really, these are the core beliefs that underpin what it is we do at Efficient Advisors as we help advisors like Frank and his team. So we all know why we have to invest. I think we know, right? The goal here of investing is to beat inflation over time, to have some purchasing power over the long haul that allows us to be able to not only beat inflation, but have a little extra money left over to do whatever it is we want to do, right? So this is a big giant chart. I don't expect you to be able to see every number that's on here, but the point is inflation is this constant thing that we're up against. This is going back to 1926, and a dollar grows to about $16 in terms of inflation erosion of your purchasing power, or you could think of that in the opposite, right? Like it's 16 times more than it was when the chart starts, right? So we understand we have to beat inflation. We got to own things that beat inflation. Short-term treasury bills tend to beat inflation a little bit, right? So 22 is more than 16. That's great, but it's not a whole lot more. It doesn't leave you much to spend, right? Long-term government bonds did better than inflation over long periods of time. That's great, but this is extraordinary. Look at how much better the stocks did than inflation or even long-term bonds did over the long haul. And why do you suppose that's true? I know if your mics were unmuted, you would probably tell me because risk, because the stock roller coaster is a scary, scary thing to be on. And that is the answer, right? Risk is the reason that stocks tend to do better than bonds or risk-free instruments over time. And look at this. This is amazing, right? That's just large stocks. Think of like the S&P 500 that you look at, you check on your phone every day. What's the index doing? Small stocks, small companies in the US tended to do way better than large companies in the US. Why do you suppose that's true? Well, oddly enough, it's the same story. It's the risk story. Again, the roller coaster for small stocks is actually even scarier than the large companies' roller coaster. But if you understand that, you can take advantage of this engine. So we're confronted with this conundrum, if you will, of, well, when's the best time to invest? This is a chart of when the stock market was up. I'm just looking at US returns, right? Like all the stocks in the US. When the markets were up, that's the blue boxes. When the markets were down, that's the red boxes. Well, the extraordinary thing is, even though it doesn't feel like it right now, maybe, the positive years outnumber the negative years by about 3 to 1. 75% of the time, at least over the last, I can't do that math in my head, 80, 90 something years, the markets have gone up. And they've also gone down. But we don't know when they're going to do either. But here's what's crazy, even though you can't see the numbers, and it's probably good that you can't, you can see the chart. That's kind of all you need to know. There's way more blue boxes than there are red boxes, and they're taller. So that means if we want to tap into the engine that beats inflation over time, we're going to have to allocate some portion of our assets to the roller coaster and the amazing engine that is the wealth creating engine that is stocks. This is the chart that I call what happened the last 7 times the world ended. I think we all know, I hope we know, that the world didn't actually end at the October 1987 stock market crash or the U.S. savings and some of you, I'm sure, on this call are old enough to remember the U.S. savings and loan crisis. I do, but I wasn't Yeah, I was just barely getting into the investment business at that
I
point.
remember all of the above as a little sidebar for all of our listeners. I was in the business through all of these. That's
Okay,
where
so
my hair
yeah,
went.
there you go. I think I started in 97, so I definitely remember the ones that have 98 plus on them, right? So Asian Contagion, the dot-com bust, right? So the point of this is, what happens if you freak out when the world ends, even though none of these were actually world-ending events. But at the time, it seemed like it. Remember, they were unprecedented. We'd never seen anything like it before. So the short bars, the first bar is what happens if you can just stick with it for 1 year. The second bar is what happens if you can just stick with your strat. We're just assuming everybody has a balance, 60% stock, 40% bond strategy, right? What happens if you can stick with it for 3 years? What happens if you can stick with it for 5 years? I hope it's not overly elementary, but the reality is the longer you can stay disciplined, the more the market rewards you, even if you have to go through a world-ending event that didn't turn out to be a world-ending event. Like, I would imagine that this chart's probably going to expand. There'll be an 8th world-ending event that happened in 2020. What was it?
COVID.
That's right. It was COVID, right? At the time, it seemed like this is unprecedented. We've never been against anything like this before. Who knows? This might be the meteor that takes us all out. God forbid. The reality is, if you could stay disciplined and stick to your strategy, you would be rewarded, particularly if you didn't freak out when the market was down and turn a temporary decline into a permanent loss. The second thing that we believe in strongly that's based on all this evidence is you can't find managers who can outsmart all of that stuff I just showed you in advance. They don't know. Nobody really knows when markets are going to go up or when they're going to go down. And even if you can find a manager who ran a fund or whatever, a strategy that did well in the past, even in the last 5 years, let's say they were in the top quartile, that they were in the best 25% for the last 5 years, the reality is their ability to repeat that performance over future is really, really horrible. It's about a 1 in 5 chance. You got about a 20% chance, 1 in 5, that a quote unquote superior manager who did it in the rearview mirror will actually do it for you going forward. So we avoid that. We don't hire managers who think they're going to outsmart prices for us. What do we do instead? Well, we focus on owning stocks because that's the engine we need to beat inflation. We're going to own stocks wherever they freely trade across the globe. Like 50 countries, thousands of stocks, 12 to 13,000 stocks in a portfolio. And we're going to put emphasis or weight, portfolio weight, on where it looks like you get paid a little bit more return for taking the risk. Small companies versus large, value companies versus growth, and high profitability companies versus low profitability companies across the globe. So this is the US column, this is international developed, and this is emerging. This idea of factor premiums, as we call them, is pervasive. It knows no borders. It happens wherever stocks freely trade. So since our core position is, I don't know the future, Frank doesn't know the future, we're not going to go hire somebody who pretends like they know the future. Let's just get that off the table. The next most obvious thing we can do is own stocks wherever they freely trade, and then put emphasis on these places where it looks like taking that additional risk or putting that emphasis there should pay us a little bit more. Now, the trade-off for this, I call this the no free lunch slide. The trade-off for this perspective means you have to understand you're going to put emphasis on a place that will not always be in favor. Small does not always beat large. Actually, stocks don't always beat treasury bills. You all have seen this in your investing lifetimes, probably. These are 10-year bars. These are decades at a time, going back to 1926. Stocks don't always beat treasury bills. And small doesn't always beat large, right? When small's winning, it's a blue bar. When it's not, it's a red bar. But the crazy thing about this slide is I look at it like a kindergartner because that's kind of the level I operate on. To me, I think, okay, I'm going to be a lifelong investor. I have to own stocks to beat inflation, and I got to own everything that's on this chart. What do I want a little bit more of? Well, it looks to me like whatever the blue bars are, I don't even care what the labels say. Whatever the blue bars are, I want a little bit, I want everything. But I want a little bit more of whatever the blue bars are. because it looks like there's more blue bars and they're taller than the red ones in the end. So that's what we do. Because the longer you can stick with the strategy, the greater the probability is. Remember, we want that arrow on the right-hand side going up. The longer you can stick with the strategy of this emphasis on small value and high profitability, the greater the chances are you'll realize the outcome you want. There's no 100% guarantee, obviously. There's no such thing. In fact, that's the paradox of investing. If it was a sure thing that small always beat large, or stocks always beat treasury bills, then that wouldn't even exist. There would be no excess return. Nobody should expect to get paid a return premium for taking no risk. The reason this is true is because you know in advance you're taking a risk. The only way you get paid for it is if you can stay patient. Last but not least, the fourth core belief is cost. Again, we understand, looking at the original little graphic, there's no such thing as zero cost. By the same token, we should not spend excess cost to do something that is low probability, i.e., hiring a fund manager to try and outsmart market prices for us or outsmart the future. We already know that's a bad idea. You only have a 1 in 5 chance of finding one who can actually repeat, and you can't find them in advance. And insult to injury, managers who say they can do it typically cost more money. There's no reason to do that. This chart just evidences that over time, the more you spend on a fund manager who's trying to outsmart markets for you, the lower the probability is they can actually do it, because cost is a big hurdle and cost shows up every day. In fact, dirty little secret, cost is the only guaranteed return, and it's always negative. Again, can't do anything for free, and we shouldn't expect to. Any reasonable strategy should cost us something to deploy. But what we can't do is spend our investment capital on undue cost to do something that is not probable. So let me shift gears a little bit and talk about interest rates, because I think, Frank, as we were putting this together, we were kind of thinking about what's on people's minds and what do they want to talk about and what would make sense for us to communicate. Clearly, the Fed, right, the FOMC, the folks who basically control the cost of money in the U.S., right, the Fed, as we affectionately know them, controls interest rates. And for a long, long time, essentially, interest rates have been almost zero on bank-to-bank rates. And everything is pegged to what does it cost for banks to lend to each other, and everything extends from that. So the point of this whole thing is just to help you all understand that what happens, or what's the relationship between the Fed changing interest rates in one direction or the other, and what happens to bond prices. So we talked a lot about stocks. We know we need to own stocks to beat inflation over time. It's not the only thing we need to own. Clearly, most of you aren't going to be able to own only stocks. Like, that's probably too scary a roller coaster ride for many of you, and I get it. We manage strategies that mitigate the stock risk by using bonds, but bonds are not immune to volatility or price change. One of the things that always changes the price of bonds is what happens to interest rates. So just to keep it simple, again, kindergarten level, that's for me. This is the teeter-totter. When the Fed lowers rates, lowers bond price rates, which we've had for a long, long time until recently, lower bond interest rates, yield, usually creates higher bond prices. The opposite is also true. So this is the environment that we're in most recently. The Fed has been raising interest rates rapidly, some might argue. When the Fed raises the rates that it costs to borrow money or lend money back and forth between banks, and therefore everything else, prime rate, everything else stacked onto that, mortgages and so forth. When the Fed raises interest rates, the price of bonds declines. So this teeter-totter is like one of those immutable truths that that exists in investing. There's no way around this. If the rates go up, the bond prices go down. Vice versa. If the rates go down, bond prices go up. Now, the reason I put this on a teeter-totter is to help illustrate the notion of how much. If the Fed raises rates, do all the bonds go down at the same rate? No, they don't. So here's something that I think most people don't fully understand, and hopefully we made it simple enough to communicate. The reason you want to stay fairly close to the fulcrum, fairly close to the middle of the teeter-totter in terms of bond duration, is because the further you go out in bond duration, right? Here's 10-year bonds, the greater the volatility, the greater the swing in prices. I don't want to get too far in the weeds, but part of the reason that there's some banks that have found themselves in a tough situation recently is because they bought bonds that were way out on the teeter-totter, right? And then the Fed raised rates, and now their bonds are worth substantially less than they were when they bought them. The reason we keep our bond portfolio portion closer to the fulcrum in the middle is because we don't want the volatility of bonds to look like the volatility of stocks. So our models stay around just inside of 5 years, about 4.3, somewhere in that range. You can know for sure, even if you hold a fairly short duration like we do, we target lower average duration bonds. The reason that we do is we don't really want implied volatility in bonds. However, we got to pick a place to be somewhere along the teeter-totter. It makes more sense for us to be short in duration, because if the Fed raises rates, this is hypothetical, let's imagine that they raised rates by 1%. If your bond duration is 4 years, and the Fed raises rates by 100 basis points, 1%, you can expect your bond prices to come down 4%. Last year, we saw the worst bond market in 50 years. And the reason we did is because Fed raised rates substantially multiple times in a row, which drove that teeter-totter on the left-hand side, drove bond prices down. Does that mean bonds aren't a great investment? Well, no, I don't think that would be the takeaway you want. In the short run, if you lost your sense of discipline and decided it's time to sell, you could take a temporary decline in bonds and turn it into a permanent loss. But I hope none of you did that, because remember what happens on this teeter-totter. When the Fed rates go up, the yield on the bonds, the interest you get, goes up, right? So if you can sit still and withstand it, you'll make up this temporary decline in price because you're making more interest over time. One of the things that most folks don't understand about bonds, and I hope this isn't too in the weeds and nerdy, but most of the return that you get from holding bonds over time actually comes from yield, from the interest that you get, not from the price of the bond. So it's not like stocks. Stocks, most of the return you get some return from dividend, but most of the returns you get from stocks come from capital appreciation. The stock started at 10, it goes to 20 over time, right? That's your appreciation, and that's the capital engine. That's the wealth engine you're tapping into over time. With bonds, it's unique. You don't get a huge amount of appreciation by buying a bond for $1,000 and somehow selling it for $1,200. Over time, where bonds really pay in the portfolio is by the yield, by the interest that comes in over time. So it's not very much fun to go through a period like we're in right now, where that is raised interest rates. And if you look at your portfolio and you see your bonds down 10%, you think, holy smokes, I didn't think bonds could even go down 10%. Now, some of you have been around long enough to have seen that before, but that was pretty scary in like 6 months. We haven't seen that in 50 years. The flip side of that is your bond portfolio that was yielding virtually nothing, and I'm oversimplifying it, but it was almost nothing 18 months ago, right? We all remember mortgage rates were great, but your bond yield, like the bond portion of your portfolio, was hardly generating any interest, and there was nowhere to get it unless you wanted to go way out on the teeter-totter or take quality risk and buy bonds that were scary risky. We're not going to do either one of those things. The good news is now, even with a 4-year duration roughly, our yield, right, the interest that those bonds are paying is around 4%, a little more than 4%, which means if they go down 1%, let's say, with another increase from the Fed, it doesn't take very long to make that up. Right? The interest rates coming in every 6 months or whatever. So just wanted to touch a little bit on, what's going on with interest rates. We don't have a short-term market outlook about what's going on with interest rates or what we think the Fed's going to do next. That would not be congruent with our whole belief system, which is we don't know and nobody else really knows. The bond market kind of prices that in, and we believe it. That's why we stay close to the middle of the teeter-totter.
Hey,
So with
John,
that, let me turn it back to you, Frank, and see if there's any questions or anything else that we should cover.
there's nothing in the chat, but just for our listeners and those that are following you, when you look at what occurred last year, it was a very rare year because historically we would say, hey, you know what, bonds and stocks oftentimes would go in different directions, providing for a little bit more stability. Where last year both of them showed negative, which is not the norm, but it does happen. And so when it does happen, it's important to understand is these things happen, but it's not the norm that it happens at the same time. And even if someone was in treasuries last year, which are considered to be very safe, whether you were in a 5-year or 10-year, and like we're talking about those banks that got in trouble if they went out long term, you're talking double-digit losses on those bonds. Some of them lost more than stocks. So, and they were good quality investments. So it does happen, but in the overall cycle, and John, as you're going through it, it's a part of what's expected. These things happen. We don't like it though.
Yeah, it's not fun. The thing to remember, that's a great point. The thing to remember is there's really only one way to take a temporary price decline, whether it's bonds or stocks, take a temporary price decline and turn it into a permanent loss. And that is to get worried enough that you change your strategy.
Yep.
Right. So my encouragement to folks would be, you've got to, if you're holding a portfolio that's designed to last the rest of your lifetime, don't let a 6-month period of crazy things happening in bonds or crazy things happening in stocks, including if it's accompanied by headlines that say, no, seriously, this time it's different and this is unprecedented and we've never seen it before. Folks, I hope you know, and I would imagine many of you have been around long enough to remember, every single time we go through any sort of market shock, it's unprecedented and we've never seen it before. Like that's the only constant in markets, and it's the reason we can expect a return.
Thank you, John. And I just got a text from someone that it seems like the chat may be disabled for some reason. I'm gonna check that. So I'll let you keep going and I'll see if there's something I could do to help it.
Okay. I didn't have much else to cover other than questions, but I do have like some backup charts in case anybody asked about it. So maybe I'll just talk about that to fill some time if you want. Do you got a question?
I was going to say, John, since the chat is not working, okay, perhaps I'll raise a few questions for you that people may have.
Put me on the spot, sure.
I think that you and I are doing this long enough. I think you'll be fine.
Yeah, that's good.
So, John, when you look in terms of somebody putting together a portfolio, and they're going to have a combination of stocks and bonds, and from what you've indicated, you do what is referred to as factor investing. There are people out there that will try to time the market, and my question is how have you seen that work over time? As far as because we do have a saying, it's time in versus timing. Perhaps you can take a few minutes on that, because either through someone's emotion, such as a client, or not only from the client, but perhaps even from an advisor who's trying to time it for them. What is your thought?
Great question. So I don't have a cool chart to go along with this, but I will tell you that I'm going to go up here just for a second and we'll talk to my I'll use my no free lunch slide to talk about this a little bit. The amazing thing about this pattern is there isn't one, right? So as you said, it's time in the market, not timing the market. The reality is folks who think that they can get it right in advance, number one, they're wrong more often than they're right, because you can't be wrong, and I mean you can't be right in advance. And number two, the reason that we hold on to what is statistically the most probable thing to do, and then understand we're going to go through periods where the thing we're focusing on, let's say it's value, is a red bar, like we've been in the value valley, if you will. I don't know if this is the third or fourth time in my career that value's been dead. Probably not dead this time either. It wasn't dead the other time. But we go through periods where value's out of favor. The reason we own both growth and value is because we must be diversified. That's the core principle number one. The chance that you could get the right timing of when to switch from growth to value is infinitesimally small, and it's basically like playing the lottery. Here's how you know when value is beating growth: when you can see it in the rearview mirror. What that means then is, if you weren't already there, if you didn't already have an emphasis on value over growth, you probably missed most of the move. Same thing with small, same thing with high profitability. It doesn't win all the time. It's pretty consistent. We've only got data that goes back about 4 decades on that. But that's plenty enough to make a clear decision that it makes more sense for us to own all the stocks, but put a weight on high profitability stocks. The reality is, day in and day out, we don't know what's going to be the winner. And when small tends to beat large, that usually comes in very short periods of time. And if you weren't already there, like if you figure it out after a quarter of small beating large, you probably missed most of the move. So trying to get that timing right in advance is exceedingly difficult, and frankly, it's unnecessary. The rewards of staying in a disciplined portfolio that's built to own all of this stuff and put emphasis on where we expect to get paid more over time, and just rebalance it when it does the opposite of what we thought it was going to do. We're going to sell the things that are more in favor and buy the things that are on sale out of favor. The reality is that the returns you can gain from sticking to that program are perfectly generous. You don't need to get the market timing perfectly right in order to have some sort of huge difference at your retirement between whatever cat food and caviar, right? Like that's not how it works.
John, we've got a question in the box. You see
Oh,
it's
Q&A.
working.
Yep. Yep.
With regard to age, what is the best time to start investing? So kind of seems like planting a tree, but I'll let you answer that.
No, you stole that's what I was going to say. If I use my life experience, and maybe yours too, the Chinese proverb, right, about when's the best time to plant a tree, right? Today, when's or the second best time is today. The first best time was 20 years ago. So I would say the best time to invest, if the goal is to create wealth over time and have something that beats inflation in the future that you can spend, the best time to start investing is as early as possible. There is another proverb, and I don't know where I stole this from. I don't know if it's Chinese. Time is only on your side once. So the reality is, markets reward patience and discipline over time, but the one constant is the time. So the earlier you can start the eighth wonder of the world, which is compound interest or compound gains, working in your favor, the better. And I say the same thing to folks who aren't worried about how young they are starting investing and are worried about, I have money, is now a good time to invest. The reality is, if your time frame is any more than 3 to 5 years and you're thinking about creating wealth over time, statistically, the best time to invest is right now, right? When you have money and when the market's open. If you're inside of 3 to 5 years, let's say, and you know you're going to need the money and inside of that time frame, then probably you don't want to subject it to stock market risk. But if you're thinking about more than 5, 10, 20 years, I'm trying to create wealth for a lifetime, there's no better time than the present to start investing, even if it's small.
Hey, John, another perspective is, sometimes it gets a little blurry with regard to, well, what is growth and what is value? When you're thinking about, what people are holding. And so do you have some examples perhaps that you can share on how do you view growth and how do you determine value, which is which?
Yeah, I mean, there's a quantitative way that the guys that actually run the portfolios and choose the individual thousands of stocks that fit in there measure this. So let me say that first. There's a quantitative mathematical measure that applies to value versus growth, and we call it book to market. And that is what the price of the stock is versus what the book value of the company is. The way to think about value is the stock price is very close to the actual book value of the assets that the company owns. Growth companies trade at a multiple of the hard assets that the company actually owns. The stock price is significantly more than just the hard assets. If we liquidated them today, what they would be worth. Growth companies tend to trade at a high multiple of the book value of the company. So the other way to think about it would be, I'll use a simple example that's hypothetical. If you have a mom and pop cafe, right, where you go get coffee down the street, not part of a chain, and the mom and pop cafe goes to the bank to get a loan, do they pay a higher interest rate or a lower interest rate than, say, Starbucks? What do you
I would
suppose?
say they're going to pay a higher interest rate
They're
because
going to pay a higher interest rate.
they're,
Why is
they're a
that?
greater risk of default.
There it is, right? They have less assets, right? And they don't have the profit stream, let's say, of something like a Starbucks. Now, if you flip that on its head and you think about long-term rates of return, yes, the smaller one, right, mom and pop shop, has more risk than, let's say, Starbucks. However, which one has a higher expected rate of return?
Mom and pop.
The mom and pop does, right? There's risk involved in that, and you might be wrong. Mom and pop could unfortunately go under. That's why we don't try and pick individual winners of mom and pops. We hold 800 or 1,000 of the smaller companies that when they go to the bank, they have to pay a slightly higher interest rate than the really big growthy companies because they're slightly higher risk. The difference, of course, is we get information. We understand that the stock price tells us about the future implied return of the company. And companies that trade at a multiple where the stock price is getting closer to just the fire sale value of if we liquidated the company and sold everything, that's less risk in the long run, which means they have more upside or implied return. So hopefully that explained it, but that's value versus growth.
Very good. And then, John, as we're just, some of the different examples is, we used to kid about it, and because you hear like Warren Buffett and and big names like that, but the reality is people didn't know who Warren Buffett was until Warren Buffett was. So
exactly.
with active money managers and people that believe that they can add value like that.
Yep.
Maybe just take an extra minute or two and
Sure.
share, what's the likelihood of that? And, even when we look at that 10 or 20% that may actually outperform their benchmark, is it the same one or are they random?
No, so that's a good question. And you're absolutely right. We didn't know about Warren Buffett. It's the difference sort of between empirical evidence and just kind of random evidence, if you will, or what's the word I'm searching for and missing. Oh, I'll think of it in a minute. The reality is this study evidence, and this is one of hundreds, shows you that typically we find it as quote unquote superior manager because they managed to beat, let's say, their benchmark or be in the top quartile, in the top 25% of all the people trying to do it, all the other managers trying to do it. Looking in the rear view mirror, anecdotal was the word I was looking for. So the difference between anecdotal evidence and empirical evidence. Anecdotally, actually empirically, I could prove to you that somebody won the lottery last week.
Right.
But frankly, that doesn't give us any explanatory power about their ability to do it this week or whenever, a year from now. And the same thing's true in this study. We had managers who were actively trying to beat the market, and look, there's thousands of them. If you think about, try to imagine a casino with a floor of 1,000 roulette wheels, right? And we count down, and everybody's going to go at the same time. 3, 2, 1. Everybody rolls. 1,000 roulette wheels across the casino. Well, statistically, no matter what happens, a certain percentage of the people at the end of when the ball gets to wherever it's going are going to be yelling winner. There's no question. That's just random distribution of luck. That's what's going to happen. The same thing happens with managers trying to outsmart the market. Our challenge as investors is we struggle to, and we find patterns where they don't actually exist, and we misappropriate explanatory power to, oh, I found a manager who did it the last 5 years for somebody else, by the way, right? You didn't, you now discovered this manager, or you read an article about this manager, right? So now I found this guy who apparently had some sort of quote unquote skill to outsmart markets. Now I'm going to invest my money with this manager. I already know in advance that I only have a 1 in 5 chance that they're going to stay in the top quartile, which really means I have a 3 to 1 chance that they're not in the subsequent 5 years. And I'm going to pay a premium to do it. It's going to be expensive, right? Like these guys tend to charge more to ride along in their supposedly market beating strategy. But you're absolutely right. The only way the hindsight bias is a horrible killer to our whole mental process. And the only way we can identify people who did it in the past is to go through time where they managed to do it. And we don't explore, well, who didn't do it? Where are all the funds that didn't even make it through the 5-year period? There's hundreds of funds that close all the time because they fail at their mission. Peter Lynch, right, who ran the greatest fund of back in the 80s, 90s, right, or beating the S&P 500 for however, even Peter Lynch couldn't find the next Peter Lynch. So the point of this, of course, is you're not sacrificing anything by removing the low probability and high cost of hiring an active manager to outsmart the future for you. You're not sacrificing a huge amount of return that you might have realized, certainly not in a reliable way, because the markets, if you forego this, the markets in the way that we invest in an academic way are perfectly generous, right, to reward you over time. And you don't have to chase this. I always tell advisors who are working with clients that have struggled with this, when do you hire a superior quote unquote manager? Well, when you can find them based on their track record, that's when you hire them. That's when you decide I'm going to invest in their fund. When do you ultimately fire them? So you hire them when they made somebody else money, right? You didn't own the fund,
right?
Somebody else owned the fund, right? So you hire them after they've made somebody else money, and now you want some of that. So now you own the fund, and now they're one of the 3 out of 4 who don't beat the market going forward. So now what do? You fire them. So you hire them after they made somebody else money, and you fire them after they lost you money. If you want to eliminate that whole process from your investing strategy for the rest of your life, we can help you.
So John, that'll lead to the next and the last question that I'll ask
Sure.
you then is, then should I just go out and buy an index fund? And wouldn't I be better off having just done that than all this other stuff?
Yeah, that's a great question too. Um, the reason you would own an index fund in its purest sense would be to avoid this process, which is broken, the one we're looking at on the screen, which is broken. And if that's all you could do, I still think you'd be better off than than hiring somebody to speculate about future prices for you. So, but to answer your question, um, owning an index fund is a way to get broad market exposure for a very low cost. And that's great. The good news is we're going to have a super broad market exposure at a relatively low cost. But on top of that, we're going to strategically, so we'll be kind of index like, but index on steroids, I guess, or index with a specific focus on, rather than letting market capitalization or the size of the stock decide how much we own in our portfolio. We're not going to be bound by a commercial reference standard for what the index is. We're actually going to own things in an academically meaningful way that focus more on small than large, more on value than growth, and more on high profitability than low. And so, in the sense of it's the best of both worlds in that sense. In that I'm going to have index like super broad diversification, somewhere between 12 and 13,000 individual stocks in 50 countries, but with a specific and purposeful strategic focus on small value and high profitability that you can't get by just sort of naively indexing.
Very, very good. And so, as for all of our guests this evening, some of the takeaways that I'm hoping that they get is, um, again, you don't know Warren Buffett till afterwards, and typically afterwards, and then you're buying his past track record, not his current. And that goes for any type of active. As it relates to indexing, because people will bring that up. I always kid and I go, well, which one are you going to buy? Because there's several. And then how are you going to mix them together?
Yep.
And then, a few years back, they came out with the idea of screening for profitability. And so maybe take just a minute or two and address what that means, because perhaps it looks like the S&P 500, but maybe because of the screening that's going on for profitability, maybe it's a little different. So John,
Yeah.
When you talk about profitability, maybe address that one.
Yeah, that one's a little bit more nerdy, so you all have to indulge me a little bit. I'm only slightly nerdy, but here's my simple explanation of it. The reliability of cash flows in a company tells us something about the future expected returns of the stock. There's a formula for it. So it is a mathematical formula on how to decide whether something is relatively high profitability or low profitability. The point, though, is things that tend to have higher unlevered cash flows, right? So EBITDA divided by book value, or a book equity is the formula. Things that tend to have higher unlevered cash flows tend to be more robust companies in terms of growth. So if you think about, I'll use a simple example that's, again, hypothetical, Coke and Pepsi. Let's say that they're both large US companies, which they are, right? They're large, they have a big market cap, and they're US based. So, all right, so large US companies, and they're maybe not growth, and they're maybe not value. They're a blend of growth and value. Well, we're going to own thousands of US companies, somewhere north of 4,500 in the US. We're going to own Coke and Pepsi, let's say, in our portfolio. So now the question becomes, all right, I know I'm going to own Coke and I know I'm going to own Pepsi by virtue of it's got to be in there. How much do I want to, how much weight do I want to, is there a reason that I might want to own a little bit more Coke than Pepsi? And the screen for high profitability would be, well, let's see which one has higher unlevered cash flow. Is Pepsi more high profitability by that measure than Coke? And these are numbers that we can know, right? Because it comes out in the income statement and and the balance sheet, like this is all publicly disclosed, that tells us a little bit more, but it's not a binary decision of I'm going to own both. I'm going to own Coke and I'm going to own Pepsi. The real question about high profitability is which one of those two might I want to put more emphasis on or less emphasis on based on the underlying characteristic and what that tells me about the future expected returns of the stock.
It's a great
Hopefully that
insight.
wasn't too nerdy.
No, and John, the reason why I bring these up is because at the end of the day, I always say investors have a few decisions to make when they're
Mhm.
going to invest. They can go with someone who's going to try to pick and choose, and that's why we look at active versus more passive, and then the extreme to that is passive, and then there's factor investing, which is what we're discussing tonight, which is by taking the academics and the science of looking historically over, let's say, 100 years, and we apply some of those factors to how portfolios are tilted and what we're owning and how they're diversified and reallocated. Do we help to provide more opportunity, potentially more return, and maybe smooth out the ride a little bit more for the client so that when we're going through volatile markets like we saw last year, like we see from time to time, are they able to stay in the strategy in order to achieve the return that they're entitled to because they're being compensated for that risk?
Yep. Yeah, that is in a nutshell the whole thesis of why you would want to do this in the first place. And I think the one thing about premiums, if you will, or returns that we can extract from global markets, whether it's stocks or bonds, the one thing that I can say is a universal truth is that premiums really only belong to the persistent, right? Like the dividend of being a dedicated investor only comes if you can stay disciplined, trying to get the timing right, letting the current winds of scary headlines and everything, news and whatever else weigh you off of your original strategy can be catastrophic to your wealth. And so again, like you said, the returns are amazingly generous if you can stay in your seat, right? If you can pick a strategy that fits your long-term needs and then tune out the noise when we go through periods like we are, where it looks like it's going to be the end of the world again, right? The banks are going to collapse or whatever today's headline is. The reality is the only way that you ultimately can see a beautiful mountain chart where stocks totally outperform short-term bonds or even inflation rates. The only way you ever become a participant in that process is to be an unwavering participant in an unknowable future.
And John, you did a wonderful job in sharing that with everybody this evening and the insights. And for our guests on tonight, and one of the things, and I'll just wrap up with this, which is everything that you've heard John share with you and myself this evening has a wonderful track record if you look at what's occurred over time. And although history doesn't repeat itself, we know that returns work the way they do. And one of the ways always that I say to stay in the game is you never put 100% of what you have in the game like that. You need to always have a liquidity bucket as well.
Mhm.
And I always
Yeah.
say is, when you have adequate liquidity and a non-correlated asset elsewhere, that, when the markets have the volatility, if I don't have to go to my portfolio, for an emergency fund and things of that nature, because I've done good planning, all of that is what ties together. So investing by itself is really not planning, but planning and investing being a part of the plan is really critical to really good long-term advice and good term planning. So as we wrap up, John, it's always a pleasure to spend time with you. I love when you share
Oh
with
man.
everybody. I know you're going to be, addressing our advisors soon. And for all of our friends and clients and the CNA family who are on tonight, It's always great spending time and sharing with you, and we wish you a great evening, restful, and enjoy the holiday week coming up. Thank you for being with us again. This is
Thank you,
Frank
Frank.
Gonzalos and John Resnick. Everybody have a wonderful evening. Thank you for being with us.
Thanks, everybody.